So let's go ahead and get started. The strategy versus the setup. Many traders, when they first start trading, struggle when determining what comes first, the strategy or the setup, right? This is a question I know I've gotten quite a few times. I know some of the other traders at Simpler Trading have also gotten that. And oftentimes traders think that they have to trade a particular setup and will end up forcing the trade onto particular charts, right? So they think, okay, maybe I just took a class over butterflies. I really need to use the butterfly strategy. And so they'll try and force that strategy onto charts. And sometimes, it might end up working out, but oftentimes it doesn't. So what I definitely think is that you should not try and force a strategy onto a setup, right? That should not be the case. Hey, Mike, great to see you in here. So the setup should always come first when you decide to put on a trade. Now, maybe there are other traders out there with a slightly different opinion, but for myself, I'm very much a technical trader. So for me, the setup always needs to come first before I decide what trade to put on. The chart setup will allow you to know whether or not there is a valid entry according to your trading plans, right? So if your trading plan says to enter at support resistance and the price is far away from it, then that's not going to give you a valid entry to put on a trade, right? That means that there would be no trigger or entry, so I'm not going to force a trade to put on. That's where traders partly start to lose money, right? Is they're trying to put on something, they feel the need that they have to trade, or they have to trade a particular setup, and in turn they force it onto a chart when it doesn't quite make sense for what the chart is showing you on the technical standpoint, and whether or not there's even an entry for that strategy to jump into. So instead, a chart setup can also help you determine what strategy you want to implement. That's why the setup should always come before the strategy, right? The chart will let you know whether or not, first of all, it's a chart that's telling you, hey, there's a good trade to take here. Go ahead and look at entering it, or hey, you're getting close to an entry, watch it. But the chart setup's also going to allow you to know what kind of option strategy to go ahead and implement when you do that. So is the chart set up in a strong bullish or bearish pattern well near support and resistance levels? If it is, then you might just look at a simple long call or put, or maybe a long debit vertical spread to the up or down side. Is a chart choppy and consolidating? Then you may consider an iron fly or an iron condor, right? You might consider more a non-directional strategy that kind of helps you out there. And of course, along with the chart setup, you could look at things like volatility to help you determine whether or not a strategy is good. For example, if volatility is high, you might consider more credit spreads because that's going to give you better premium. If volatility is low, you might consider the debit vertical spreads because those are going to be a little bit better on the risk versus reward. So that's also something to keep an eye on. But mainly, you're looking at the chart for that setup. Yes. Is a chart moving back? Yeah. Yes, you agree, huh? So is a chart moving back to a particular price resistance or support level? Maybe you have a target in mind for support and resistance, or a level that you're watching that the price keeps running into and then stalling at. If that's the case, then you might consider a butterfly for a pin trade, right? If there's good probability that it's going to get back to that level, then a butterfly might make for an excellent risk versus reward to allow that trade to go through. And then, of course, the chart setup, once again, will help determine that strategy. So what I want to do now is pull up some charts. If you guys have any symbols that you want to take a look at, let me know, and then we can kind of evaluate them and see whether or not there is a valid chart setup, and if so, what strategy we might want to implement around it. Yes. Yeah, Apple. Let's take a look at that one. Yeah, we'll take a look at all those. So first up on Apple, let me just pull this up here. So Apple right now is overall in a bearish trend, right? The 10 is below the 30. Both are below the 100. But we're also seeing signs of consolidation. Notice how the 10 period simple is starting to roll up towards the 30. Notice how the Bollinger Bands are turning flat. Momentum is also pulling back towards the zero line. We have a choppiness in breakout signals, and we have a daily squeeze. Now on Apple, sometimes the daily squeeze can fire quickly. Other times it might print a while like it did back here for over a week before it ends up firing. So looking at this right now, for me, I would probably want to lean towards a more non-directional strategy like a credit spread or an iron condor because we're in this consolidation around this level. So let's pull up the option chain and then see what strategy kind of fits versus the premium and strike levels that we're looking at. Apologize about that, guys. She got a little handsy. She's like, I will control this today. There we go. Okay, so Apple here, we can see, right, is more non-directional. Now, for me, I typically like to look more at non-directional trades as shorter term trades. So I'm going to look at a closer expiration, like the next week's expiration. And right now we can see that the high of yesterday's bar was around 270. We certainly have resistance around 280 that we could run into and stall at. Bollinger Bands aren't flaring open yet, so they're not anticipating a move higher right now, but 280 kind of seems like a safe spot to the upside. At the same time, 250 is a nice psychological level. It's right by the 10-period simple. And other than this little dip that we had below it down to 240, you can see that the price kind of holds that level pretty well. So 280 to 250, 240 would be the range that I would consider Apple trading into next week. So Ryan actually mentions he got into a 275, 260, 245 butterfly on Apple. And that to me looks good, right? So that's actually, I was going to consider a trade very much like that. But what I was going to start to consider here was an iron fly. So you have the right idea, right? That's a bit more of a non-directional trade idea that allows you to trade in between those levels. So if I wanted 260 as a pin for next week, 240 and 280 seem as pretty good support and resistance levels. I can see here I'm making a 20-point iron fly. There you go. Let's see if you want to go down there for a bit. Yeah. So 240, 260, 280. Make an iron fly. The wings are right at those support and resistance levels, both on the high and low end. It's a 20-point spread, and it's looking at a 1260 credit. So 1260, let's say we get a slightly unfavorable fill and it's 1250. So a 1250 credit, 750 risk. So not a bad risk versus reward. But maybe on an iron fly, typically, personally, I like a little bit more premium than that when I'm looking at jumping in. So narrow the spread, kind of like what Ryan did. We'll bring it in a little. 275, 245 makes a 15-point spread, 1080 credit, 420 risk. So we reduced our profit potential a little bit, but we even more so reduced our risk. So I think I kind of like this as a potential trade idea. 245 is very close to that 240, 250 level we talked about. 275 is just slightly below 280, still outside the Bollinger Bands. And because the Bollinger Bands aren't flaring open, to me, that still seems like a good level to consider. So this might be the trade idea we implement in this non-directional consolidating choppy pattern right now. Now, if of course it starts to break above or break below, you'll want to take management action accordingly. But for the chart setup that we're seeing now, it looks to me to be more in consolidation. I don't necessarily want to take a bearish trade here with the technical trend because the price has now broken above the 10 and the 30, trying to hold that as support today. So if we start to strongly break below that in the 10 today, I'd be looking more at a bearish directional trade. But the fact is we're holding both of these levels. So to me, that means I want to consider more a consolidating trade. Now, let's say, this is maybe still a little bit too much risk for you, or you want a smaller width spread, but you like these levels back here. Well, you could also consider an iron condor, right? Let's just see what a 5-point iron condor looks like. So here we're keeping in mind the 275, 245 as support and resistance. 250, I kind of like this spread here because that's right by the 10-period simple as well. So that has a good probability of staying out of the money. 270 is right by our prior high. So this doesn't give us as much wiggle room. We'll take a look at here in a second, moving it down to the 275, 280. But we can see for risk versus reward still doesn't look bad. We're getting about a 260 credit versus a 240 risk. So it's a pretty even risk versus reward, and we are giving ourselves space for the price to trade in. As long as it stays between 250 and 270, this would all expire worthless and be a profit for our account. Really quickly, if we did 275, 280, a little bit less credit, a little bit more risk. But that to me also shows it has a greater probability of working out. The market makers aren't anticipating the price to get up to this level, which is why they dropped off the premium on us. So it just depends what kind of risk versus reward you want to hold over the weekend into next week if this was a trade you're considering putting on. So as you can see, we had a few different strategies that we could consider here, but they all complement the chart setup. So let's keep going on. Up next was, yeah, she likes the butterflies, Mike. Absolutely. I think she actually likes that trade. Maybe I should put it on as a baby indicator trade. So TDOC. So here's the next one that we have. Now, this has definitely been more a bullish pattern, right? The 10 is above the 30. Both are above the 100. TDOC has not fallen apart like a lot of the other symbols like Apple that we saw, or the rest of the market, really, right? It's had a bit of a dip here, but it held support, certainly maintained the bullish pattern, and then bounced back up. Right now, though, we've dropped back down to a support level. So we are seeing a bit of a pullback. In line with that pullback, momentum's pulling back towards the zero line. We have a valid pullback signal on the compound breakout tool. So this is one where I would definitely watch it into the close today. And if we can maintain holding the 30 period simple as support, I might consider more a credit spread. The reason why I would consider a credit spread rather than like a long call is because a credit spread could still benefit me if we go further into consolidation, right? Which is kind of what we're getting now. Bollinger Bands are starting to turn flat. Momentum's resetting. We have these pullback signals. So a credit spread would, first of all, be a lot less risk than jumping into something like a long call, because we can determine that with the spread width. And then also a credit spread can benefit me if we don't see as much movement in the price, right? If we kind of have a day like the last few days where we just kind of hang out around this level, as long as the short strike remains out of the money, we could walk away with a profit. So for me, of course, right, the trigger for this trade would be that we have to hold the 30. If this starts to go back to the low of the day and close there, then this to me is a chart that does not have a trigger or entry, and therefore would not be a trade that I would want to consider putting on. So back over here, April monthly is next week's expiration. It only has monthly expirations, but thankfully it's next week, so we can get the benefit of that theta decay to work for us. Right now, we're right around the 140 strike. So if we did 140, 135, we're looking at about a 220 credit, 280 risk. Not a bad risk versus reward there, given that our short strike is out of the money. And the idea, of course, is that it will maintain holding this level or bounce up to where we can walk away with a profit on this. Another reason, in particular for this week, why you might lean towards credit spreads than debit spreads is because Friday is a market holiday. So when it's a 3-day weekend like this, whether it falls on a Friday or a Monday, sometimes credit spreads are going to give you more of a benefit. The reason why is the theta decay is still working over the weekend on your strikes, right? As we get closer each day to expiration, that theta decay is going to take effect. So basically, we have a free day of theta decay on Friday without the market, and in particular the underlying asset price, moving against us on that day. Now, it doesn't mean it might not move against us on Monday or Tuesday, so you still need to be, smart about your risk versus reward on the trade, as well as your overall risk in regards to the trade to your capital amount in your account. But that theta decay on a credit spread, if we remain out of the money going into Monday, might actually allow for a pretty decent profit earlier in the week compared to if it was a normal weekend that you're holding it through. So on top of it just being a bit higher volatility, with it being a holiday week, that's another benefit of maybe putting on a credit spread as a strategy at this time. So this to me looks like a pretty good trade if we can hold the 30 period simple to close today, and certainly if we make this bullish divergent bar like we're trying to now, if we close at the 30, we will be making a bullish divergent bar today. So if we see that, that's another sign for me to consider putting this on. So I'm actually, let me get out my journal here. I'm going to actually write both of these down because I like both Apple and TDOC. As of right now, at least, I'll take a look at those into the close. But that might be something I consider for my own accounts. So. Wiley, both can be considered. So Wiley's asking, is an iron condor is more for sideways movement or consolidation, and butterflies for directional trades? Yes and no. Butterflies can also be great for non-directional trades too. It's just, for example, if we went back to Apple and kind of looked at the trade that Ryan was talking about holding for this week, he is in the 260, yes, 275. I don't know if it's the put or call side, but either way, it'll probably be similar cost basis, right? So let's say it's the put side, the 260, 245, 275. So you can see right now, this is a 765 cost basis, which is your risk, 770, 730 profit potential. So right now it's a pretty even risk versus reward. I'm sure if he opened this the other day, it was probably a bit better risk versus reward because you're seeing that intrinsic value build into this on the debit spread side. You're seeing the theta decay work on the credit spread side as we get closer to expiration, which is only a day away, right? So each day that this gets closer, this is going to start showing more of the value of the butterfly width if you're by your pin strike, which he is. So that's a benefit. As you can see here, though, let's say I wanted to open this up today, then you're paying a bit more when your pin strike is at the money, right? And that's just the thing with butterflies. If your pin strike's closer to at the money, typically speaking, not always, but typically speaking, you're probably paying a bit more than if you had a target level that you're playing into and you opened the butterfly out of the money. So you just need to understand that risk versus reward, but it doesn't mean that it still can't allow for a profit if it's moving choppy, right? So this could still be profitable. An iron condor definitely is more for sideways range, right? Because you're wanting it to stay within a bracket. Like for our example here on Apple, if this was a this week expiration, right, we would want to stay within a bracket. So that's what we'd be looking at there. And if you can't tell, she is finding her vocal cords. So yeah, Michael B, if you want an explanation on the divergent bar, I'll go over it here just now. But if you check out Friday's archive, last Friday's archive of the training room, I go through my entire chart setup and the indicators, and in that I do talk about the divergent bar indicator. So please feel free. But basically, the divergent bar is an indicator that Eric helped me code, right? I wasn't sure how to code it. But the idea here is if I get a bullish divergent bar like I'm seeing today, there's a good probability that within the next 3 bars, I will see some sort of higher high compared to this current bar. So here, we still have one more day to see if we get a follow through of a higher high. May or may not happen. But back here, for example, let me just zoom in a little bit more. Here was a bullish divergent bar. That next day, we followed through with a higher high. Here is a bullish divergent bar. Now, this one, it took 4 days to follow through. So it was a little bit outside my personal time limit. But you can see it did end up following through eventually with that higher high. Back here was a bullish divergent bar. Next day was a higher high. Bullish divergent bar. Next day was technically a higher high, but certainly that following day would have made for a better profit. Back here was a bullish divergent bar. Next day, higher high. This was a bullish divergent bar that took 2 days. This bullish divergent bar took 3 days to follow through. But you can see oftentimes here's another one higher high, another one higher high. So with a bullish divergent bar, especially when it's in a bullish trend, it's typically a signal I don't mind taking. Vice versa, a bearish divergent bar, which are these light pink bars on my chart, typically mean that you're going to find some sort of lower low within the next 3 bars. Now, I don't usually take bearish divergent bars and bullish trends. That to me is more of a signal to consider protecting profits if I was in a bullish trade, because it's a counter trend signal, so it's less likely to follow through. Here it did, right? We printed a bearish divergent bar, followed through with a lower low. Here was a bearish divergent bar. It too followed through with a lower low. Here were two bearish divergent bars. This one took the third day to follow through, but this one never did, right? So that's why typically in counter trend signals, I don't take it. Now, if this was a bearish trend and we had a bearish divergent bar, then yeah, absolutely, I'd be taking a look at putting on a trade there. And Ryan, yeah, how do I determine whether to use calls or puts when entering a butterfly? For me, I'm looking at it as a pin strike that is, so let's say on TDOC, for example, let's go back to that. Let's say on TDOC, now for myself, please keep in mind, I would still be using a call put credit spread. That would be my strategy of choice given this chart setup. But let's say we are getting bullish signals here and we have a good sign that we're going to go back up and pin around 155, 160 going into the close of next week. So for me, I'm looking at the pin strike where it's out of the money. Because if the pin strike is out of the money, then that means I'm going to probably get a better risk versus reward on the trade. So in this case, if our pin is to the upside, I'm going to look at a call butterfly with the 160 pin. Let's just say it's a 10-point butterfly. And there you go. You got your risk of $1.25, your reward of $8.75. And you can see you can play that to the upside going into 160. Let's say instead we were continuing with the bearish signals. This dropped off into the close, and it really looks like going into next week, we're going to go back down to this low here around 120 and stall. So 120, that strike is out of the money on the put side. So then I would go over here, look at the 120, 130, 110, for example, and that would be my put butterfly. So for me personally, it depends on where the pin strike is, and ideally on the side that it's out of the money on, whether it's the put or call side, that's usually the side I'll enter the butterfly on. So I know we had a few other symbols. Let's see, Amazon. Yeah, let's take a look at that. So Amazon, what are we seeing on the charts? Well, Amazon is seeing a nice move to the upside. We've broken the ATR trailing stop as resistance. The 10 is above the 30. The 30 and 100 are kind of converged, but if we continue higher, the 30 is going to start to roll up off that level, kind of like what we saw the 10 period simple do back here off the 30. And in turn, that's going to make a bit stronger of a bullish formation. We also have Bollinger Bands flaring open, so they're anticipating the price moving higher. We have momentum crossed above the zero line. That's a bullish sign in itself. And then we're continuing with green bars above it, so that's all bullish. Compound breakout tool is still showing some consolidation, so we might want to be a little cautious there. But everything else is looking good for a move higher. Now, we're not near support, right? We're not near the 10 period simple. We're not down here near the 30 or 100, showing that we're bouncing off those levels. So for me, don't necessarily want a credit spread, right? Much like TDOC, I prefer credit spreads when they're right near support or resistance and then stalling there. That to me is a better opportunity to get a better risk versus reward on a trade. Here, I don't necessarily want a credit spread because we're, well away, over 60 points away from our support level down here. At the same time, we're also away from that level for a long call, right? And for myself in this account in particular, I would not want to jump into a long call because it's rather expensive on Amazon, right? If I were to go out 30 days like I typically look at for a long call, it's well over $100 to look at something in the money. So that doesn't make sense for this account. So instead, what I would look to do to play this bullish sentiment to the upside is look at a long debit call vertical spread. Now, once again, much like volatility is something we keep in mind, we also need to keep in mind when earnings is coming up. Now, you could look at a long call with this next week expiration to earnings, but that's still rather expensive, right? And that's because of the uncertainty. Hey there. Yeah, there you go. So because of that, I would stick to the week prior and look, which is next week's expiration, and look at a long debit call vertical spread. So for example, Let's say we definitely think it's going to go up to 250, right? The expected range is over 70 points just for next week. So I'm going to look slightly out of the money to get a better risk versus reward and do something like the 245, 250. That's a $195, $2 cost basis, roughly a $3 profit potential. So great risk versus reward. And it still allows for that bullish movement up into this price range. If you wanted to put this closer to at the money, by all means, please feel free to do so. That just means you have a better opportunity of it going in the money. You can see it also costs a little bit more because of that likelihood of it going in the money. But that's what I'd look at on Amazon, right? By doing a long debit call vertical spread, yes, I'm not near support, but it still gives me that bullish sentiment while at the same time keeping my overall risk in check, right? And also the thing about a debit spread like this is that I don't need the price to technically move up as much as I might need it for a long call to move up in order to get in the money of that short strike and allow for that profit potential. So for me, this chart setup is leaning more towards a long debit spread to get into. If you on your charts are maybe seeing, hey, yes, Amazon looks like it's going to go up, but let's say you have indicators or something like that where it keeps showing you that it's going to stall around 2100, then you might consider a butterfly, right? Maybe the 2100, 2150, 2050. That's about an 8 basis of 4155 profit potential. So excellent risk versus reward. And you're still looking for a move higher, but you have a range and a level that you think it's going to pin at, right? Or maybe let's say Amazon to you, yes, it could get up to 2100, but it's not likely it's going to break above that level next week. So maybe instead you look at an unbalanced butterfly, right? Let me change this contract amount back to, there we go. So maybe you look at an unbalanced fly like this, where you have the extra credit spread on, gives you about $1.10 credit on a 10-point spread. That makes an, let's say it's $1.20 credit that we're getting to make math simple. So that's an $8.80 risk, but an $11.20 profit potential if it goes up to 2100 installs. So those might be the strategies you consider. Now for myself, I probably wouldn't do this one. I'd probably lean either towards the butterfly or more than likely for myself, the long debit call vertical spread to play up. Ryan, if you used calls, that's fine on Apple. If you did it, because it's still staying within that range. But if it depends, right? So let me go back to Apple really quickly. So on Apple yesterday, if you opened it yesterday into the close, doing a call or put side, it wouldn't matter because the 260 strike was right at the money. So in that case, you could do it either way. If you opened it up here when it was around 270 and you did a 260 pin, but it was on the call side, I probably would have looked at the put side personally to get it out of the money. You can certainly go with the call side. The only issue there is those short strikes are now in the money. So you have that slight risk of assignment there. Now, on something like Apple, you probably won't get assigned until literally the day of expiration or, you know, if you hold it through it, right? But that's the slight concern, which is why I typically, when it's a pin level I'm looking at as a target, I try and stick with the pin strike out of the money. And then for, yeah, not a problem. And Morris, you're talking about Amazon here. Sorry, I'm kind of jumping around here on the chat. But Amazon, right? So for earnings, the reason why you could look at a long call for earnings after the expiration is because you're not going to see, even though it's only 16 days out, you're not going to see that theta decay work against you until the earnings announcement occurs because of the uncertainty around that announcement. And because Amazon is certainly known to sometimes see gap moves when that announcement occurs. Here, we certainly got a strong gap move to the upside. Here we gapped down at the open, but then went back up. Here we gapped to the downside. So, you know, there's definitely known to be volatility around that, which is why for a run into earnings trade, you could look at a long call right after. The reason why I wouldn't look at a vertical spread, like a debit spread or credit spread for an expiration right after the earnings announcement like this, is because On those vertical spreads, you want the short strike theta decay to help offset the long. If this is holding on to all that extrinsic value, you're not going to see that theta decay work in your favor. So you're probably not going to see as big of a profit here compared to if you did it with next week's expiration where it's still prior to the earnings announcement. So when I'm looking at a vertical spread, whether it's a credit spread or debit spread for a run into earnings trade, I personally like to put those on the expiration prior to the announcement. If I'm looking at a long call or long put for a run into an earnings trade, then I don't mind going literally that next week after the earnings announcement, or, this is the 23rd, expiration is the 24th. I don't mind going with this day because the idea there for myself is that I do not plan to hold the long call or put through earnings. It's a play going into the announcement. So it's less likely to have that theta decay due to the uncertainty, which means it will hold on to the value, which is what I want. If anything, it might actually gain in extrinsic value as we build into that announcement, and therefore might allow me a quick profit that way, even if the price doesn't see a strong move up, right? In the case of Amazon. So let me see if I missed anything. So it was around 270. Yeah. So Ryan, if you did it in the morning, I probably would have looked at the put side in that case. Still doesn't mean it won't work out, right? It looks great right now. So that's just the one thing to be mindful of is, you might feel the need to stick to a call or put side, but both can be your friends, right? So keeping it out of the money, you have that less probability of getting called out on it or assigned.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me over.